real all-time high in gold would be over $3,400 now. I mean, just imagine the headlines. Just imagine the attention. You know, even crypto kings and Bitcoin hodlers could say, "Hey, look at that! There's something else that's got momentum." I think I think there are diehards in that space that will never buy gold, but I think the majority they're momentum chasers. They'll buy anything that's hot. So there's flavor of the day potential here. Could be another catalyst, if you will.
Gold as a store of value for over 2,500 years has been on a searing 16-month rally, surging more than 30% from just above $1,600 per troy ounce in late 2022. Lobo Tiggre, the CEO of IndependentSpeculator.com, recently stated his bullish stance on commodities, including gold, for the year 2024. He suggests that the potential for gold to achieve such notable price levels offers an intriguing scenario. This scenario can draw interest from diverse investors, including individuals who may have yet to contemplate integrating gold into their investment strategies. In his analysis, Lobo notes that the Federal Reserve's indication of potential rate cuts and easing monetary policy could further support gold prices. Traditionally, rate cuts are seen as bullish for the precious metal. Traders are now pricing in a 72% chance that the Fed will begin cutting rates in June, up from 65% before the rate decision. Analysts at Bank of America had previously suggested a price estimate of $2,400 per ounce if the Federal Reserve cut rates in the first quarter of 2024. Whether rate cuts occur later, they stand by that estimate for this year. Regarding geopolitical tensions and the threat of conflict, Lobo underscores how they boost the attractiveness of gold. Additionally, he points out that record central bank gold purchases continue to bolster gold prices, despite the backdrop of increasing interest rates. 5 decades of high gold purchases by central banks globally, 39 tons in January, according to WGC, and the potential for Republican presidential candidate Donald Trump to heighten tensions between the U.S. and China are reasons behind the bullish gold forecasts and price predictions. Now, we present the clips of Lobo Tiggre's insights from his recent interview with Commodity Culture. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
A key point here, and I've said this before, but I think it's an important takeaway, is all these people running around on mainstream financial media, and the political masters, I believe, saying, oh, if there's no recession by now, there's not going to be one. That's simply an ignorant thing to say in light of history. We are just now getting to where we'd be at the average length of those long and variable lags. It's even just, never mind the COVID lockdowns and the stimmy checks and all the crazy things done. Just historically, it's the long and variable lags aren't even late yet. We're just now getting to the average length. If they go months more, that would be a little bit more than average, not long overdue. So I just think that's ignorant is the charitable word. I think it's spin. I think it's people trying to convince you that something is better than it is. It's lipstick on a pig. Don't buy it. So that alone is a catalyst in my view. I think that recessionary call, that's why I'm still on team hard landing. I think that's still coming. I think the cracks that we see in the labor market, I mean, and not just the recent headlines, but the trend and the JOLTS numbers and so on have been down for months. The unemployment rate is ticking up. This is a Jeff Gundlach thing. When the unemployment rate starts doing what look like golden crosses, but when you consider the implications that it's unemployment, not employment, it's actually a death cross. When you get the numbers starting to cross the long-term averages, that is a very tried and true recession indicator. And employment is lagging, again, lagging indicator. So yes, that has a very high correlation with higher gold prices. Sorry, gold dollar exchange ratio. Gold is money. It's not pork bellies or coffee beans. So that alone is a catalyst. On top of that, we have, even without that, the Fed saying they're going to cut, or that it's likely that it'll be appropriate for them to cut, right? And rate cuts are bullish for gold. So just those sort of basic macro settings are there. And then, of course, if we look beyond the U.S. and the economic lens, we have 2 hot wars, either of which could turn into World War III at a moment's notice. I mean, it seems like, oh, well, again, if it hasn't happened by now, it's not going to happen. And I sincerely hope they don't. I'm not looking for World War III. I don't want that to happen. But there is real risk in the world of seriously bad things happening. And that is the sort of thing that reminds people that, a little bit of hedge with a safe haven isn't a bad thing. And then we've got the central bank gold buying, record levels of central bank gold buying. And what's really striking to me, and to focus this on today's conversation, Jesse, is okay, it's been going on for a while. It has supported gold at a time of higher rates and so on that normally would have been bad for gold. I think that's really important because now we're going into what would normally be good for gold, cutting rates, recessionary signals, but we're not going into it at a cyclical gold low. It's not like last time we were down under 1400, 1300, right? Or the time below, we were down below, well, I guess leading to 2019, we're at 256 or something. Like, we're not going into what looks like an obviously bullish setup for gold from a low. We're going into it at record, at least nominally, all-time highs. So the potential here is extraordinary. A modest 10 or 20% move in gold, which would be nothing compared to prior bull markets, which are orders of magnitude greater. That would take us to such screaming headline gold dollar exchange ratio numbers, a real all-time high adjusted just using the government's crazy CPI numbers, which I see as a very conservative case. Using CPI, a real all-time high in gold would be over $3,400 now. I mean, just imagine the headlines. Just imagine the attention. Even crypto kings and Bitcoin hodlers could say, "Hey, look at that! There's something else that's got momentum." I think there are diehards in that space that will never buy gold, but I think the majority they're momentum chasers. They'll buy anything that's hot. So there's flavor of the day potential here. Could be another catalyst, if you will.
Noticing a shift in silver's short-term trading patterns, Lobo mentions a resemblance to copper rather than gold, signaling a noteworthy trend. Despite the enduring correlation between gold and silver, this divergence in short-term behavior stands out. Forecasts pointing to a fourth straight yearly deficit in global supplies and a rise in demand to its second highest level on record raise the potential for silver prices to rally and even roughly double before the end of 2024. Lobo shares his broader outlook regarding gold and silver's historical tendency to move in tandem. Therefore, despite potential all-time highs for gold, silver stands to gain significantly, potentially boosting silver miners' profits. Let's get back to the interview.
Over the last 2 years, silver has been visibly trading on a short-term basis more like copper than gold. And this is what gets me the Darth Silver eggs and all that stuff, right? This is a fact. Like, you just watch it on an intraday basis. And we've been seeing, days where gold goes like this and copper and silver go, yeah, right? Now, overall, the correlation between gold and silver is still high. But this is a new thing in this space. And I think it's a fact, a trend that's worth watching. Now, the good news is that even if the gold-silver ratio keeps widening, generally speaking, they do go in the same direction. It hasn't completely broken down. So even in a worst case scenario, if gold does break out to a real all-time high, there's no way I think silver gets left behind completely. Silver may or may not reach a nominal all-time high, but you know what? Just going from 25, mid-20s to 30s, let alone 40s, that would be very exciting. The percentage gain for silver at that point would be huge, and the impact on silver miners, the marginal impact and their profit margins, I mean, not marginal as unimportant, I mean margin as in profit margin, the impact for their margins will be huge. So, and that should translate to silver stock prices. So I like silver. I still see it as a monetary metal despite my Darth mantle, and I was very encouraged. I mean, I'm not saying there's anything good about war. This isn't Schadenfreude, but a silver lining, no pun intended, of the recent wars is that we did see silver move like a monetary metal should, particularly last October. Not like copper, not like oil. It moved like gold in response to purely geopolitical threats that have, if anything, negative implications for silver's industrial demand, but very positive implications for safe haven assets in that context. So I find this very encouraging because I've been more and more concerned about silver acting like copper in recent years. And so to see silver really act like gold in a moment of crisis was very encouraging. And so I am a silver bull, but even the most ardent silver bulls will tell you that silver typically underperforms at first in a new bull market and then catches up with gold in the end. So that being the case, even though I'm a bull, I'm not in a huge hurry to deploy into silver right away. I think we have time. Given the historic pattern of silver underperforming at first. We have time to see if this breakout in gold really has legs, if it's not going to fizzle on us, and then we can, then we can bet on silver catching up later. Yeah, there's a lot more I could say, but that's the short version.
Gold, which has historically been seen as a safe haven asset that holds its value, rose to prominence among investors in 2020 amid the worst pandemic in living memory, with gains of up to 40%. The yellow metal has returned almost 20% over the last 3 years, nearly 55% in the previous 5 years, more than 40% over the last decade, and close to 400% over the past 20 years. Given its proven ability to preserve value and deliver consistent growth over time, how could gold maintain its relevance in investment portfolios going forward? Please share your thoughts in the comment section below. If you find this video informative, please support our channel and turn on notifications to stay informed about our latest videos. I look forward to seeing you in the following video.